Saudi Arabia is rustling feathers with their recent decision to purchase more Russian diesel, and it has not gone down well with their American allies. Joe Biden and company have voiced their displeasure with this decision, but it seems like a risk the Saudis are willing to take. And with the United States being one of the largest oil importers and Saudi Arabia being its largest producer, it begs the question of whether or not the United States will be passive on the matter or use its global influence to strike back. It certainly wouldn't want to lose its hold in the Middle East, especially to Russia. So today on Profit Protection, we're going to try to answer the question of how Saudi Arabia's deal affects the oil market and the players within it. Also, make sure to stick around until the end to see what steps the US is taking to salvage this relationship. Now, let's take a look at what we have. First up, let's start with a bit of background. Saudi Arabia is one of the world's largest oil producers and exporters, and they have traditionally relied heavily on oil sales to fuel their economy. However, in recent years, they've been trying to diversify their economy and reduce their dependence on oil revenue. Meanwhile, Russia is also a major player in the global oil market. They have been ramping up their oil production in recent years and have steadily been increasing their exports to markets around the world. However, with the war in Ukraine, their customer base has been getting narrower and they need the money, hence why they've been ramping up on oil production even more now. So when news broke that Saudi Arabia was planning to increase its purchases of Russian diesel, it certainly raised some eyebrows. After all, Saudi Arabia has traditionally been a close ally of the United States, and Russia is seen as a geopolitical rival. However, there are a few reasons why this move makes sense for Saudi Arabia. For one thing, they are trying to diversify their sources of diesel in order to reduce their reliance on any one supplier. By purchasing more diesel from Russia, they are creating a bit more competition in the market, which could help keep prices down. Additionally, Saudi Arabia has been looking for ways to reduce their domestic oil consumption as part of their efforts to transition to a more sustainable economy. By importing more diesel from Russia, they can free up more of their own domestic production for export, which could be a smart move in the long run. Of course, this decision is not without its risks. For one thing, it could strain Saudi Arabia's relationship with the United States, which has historically been their closest ally. Additionally, it could put them in a more vulnerable position if Russia were to suddenly cut off their oil and diesel supply for any reason. But overall, it seems like a calculated risk that Saudi Arabia is willing to take. And what does this mean for the global economy and stocks? Well, there are a few things to consider. First of all, it could put some downward pressure on oil prices, which could be good news for consumers around the world. Lower oil prices could translate into lower gas prices, which could free up more money for other spending. However, it could also hurt some oil-producing countries, particularly those that rely heavily on oil exports for their economic growth. For example, Venezuela has been in a state of economic crisis in recent years, largely due to the collapse of oil prices. If prices were to drop even further, it could spell even more trouble for them. On the other hand, some countries could benefit from lower oil prices. China, for example, is a major importer of oil as well, and lower prices could help their economy grow. Additionally, some companies that rely heavily on oil as a raw material could benefit from lower prices, as it would reduce their input costs. Additionally, it seems that the Saudis are uncertain on the US's position as a global power moving forward, as for the better part of a decade, a majority of oil and gas shipments have flowed into East Asia, and this has by in part increased dialogue between the regions. China has also helped broker a peace deal between Saudi Arabia and Iran recently, who have had an uneasy relationship for quite some time, to put it lightly. So it's safe to say that China has worked hard to pick up the pieces that the Americans have left behind, proving to be more of a proactive partner. So what does this all mean for the global economy and stocks? Well, for one thing, it's likely that oil prices will remain relatively stable in the short term. Saudi Arabia is still a major player in the global oil market, and any changes to their buying habits are unlikely to have an immediate impact on prices. Additionally, Russia has been steadily increasing its diesel exports in recent years, which could help to keep prices from spiking. However, there are still risks to the global economy and stocks. If tensions between Saudi Arabia and the US continue to escalate, it could lead to a cooling of relations between the two countries, which could have ripple effects around the world. Additionally, if oil prices were to suddenly spike or drop, it could have a major impact on the global economy. So what should investors be doing in light of this news? Well, according to a report by the International Energy Agency, oil demand is expected to increase in 2023 2023 due to a strong global economic recovery, but this may be tempered by ongoing concerns about the COVID-19 pandemic and the transition to renewable energy sources. The report also notes that global oil supply is expected to increase, with production from non-OPEC countries outpacing that of OPEC members. Additionally, another article written by UBS notes that the current environment is favorable for energy companies, particularly those focused on exploration and production, and that oil prices are likely to remain elevated in the short term, which could benefit energy companies and diesel-producing countries. However, the article also cautions that the outlook for oil prices is uncertain and that investors should be prepared for volatility in the energy sector. The article suggests that investors may want to consider diversifying their portfolios and investing in companies that are well positioned to benefit from the transition to cleaner energy sources. So, to summarize, here are 5 profit protection suggestions to help you navigate the market. Number 1, oil prices are currently elevated and are expected to remain so in the short term, driven by factors such as rising demand, supply constraints, and geopolitical risks. Number 2, the global economic recovery from the COVID-19 pandemic is driving increased demand for oil, particularly in emerging markets such as China and India. Number 3, OPEC Plus production cuts, under investment in new production capacity, and weather-related disruptions are constraining oil supply, which is contributing to the current high oil prices. Second to last, we have geopolitical risks, such as tensions in the Middle East and potential disruptions to global shipping lanes could impact oil prices and should be monitored. And last but not least, energy companies, particularly those focused on exploration and production, are likely to benefit from the current environment of elevated oil prices. Overall, Saudi Arabia's decision to buy more diesel from Russia is an interesting development, but the success of this partnership very much depends on Russia's war in Ukraine. Therefore, as there are risks involved, there are also potential benefits, and it will be interesting to see whether the United States can regain control. For now, investors should stay cautious and keep an eye on the news while remaining diversified and well-informed about the global economic trends. And with that, I think we'll wrap up this discussion for today. Thanks for tuning into Profit Protection. Don't forget to like the video and subscribe to the channel, and we'll see you next time.